everybody, welcome back to my Daily Dose with Tim. Today is Season 2, Episode 8. I like that number 8, well, because I'm Asian. Anyways, you already see that I already got my red marker in my hands. And thanks to some of you guys who actually messaged me after watching the episode, and you kind of caught my misspelling. That was really funny. So, I know. English is not my first language. I think I already told you that early on. So I actually put down an extra L, and for some reason I didn't even notice that until you guys pointed it out. So thank you so much. And that actually makes me happy. I don't feel embarrassed at all, simply because that actually shows me that you're actually paying attention to not just what I'm saying. However, you're actually making notes for yourself, and that's ultimately what this is all about. It is a learning process, and I really do wish that you take it upon yourself to retain as much as you possibly can, because a lot of the times when you come back and watch something and review something, that's when it really starts to sink in. That's when it really starts to make you go, yeah, you know what, the dots are starting to connect. However, this week is probably one of my favorite subject to discuss, which is why invest in real estate, or better yet, why leverage real estate as our main investment vehicle. Because, well, there's so many different reasons, and I'm doing my best to sum it all up in 1 week right now. And I've actually never really done the whole part 1, part 2, part 3. It's always been a bit of a build up, and it's always progression. However, I really wanted to make sure that every single component is very clear, because I understand one of the biggest advantages of doing it this way is the fact that I have a lot of students. They oftentimes get challenged by their potential investor, their cash investors, or their joint venture partners. And we all know that in the game of real estate, if you want to grow, if you want to scale up and build a sizable portfolio, it doesn't matter how much money you have right now or how much money you're currently making. At some point, you're going to hit a ceiling. Doesn't matter where you go, because we already discussed this a little bit yesterday, which is for most of us to get qualified for a mortgage, there are usually 3 main criteria that we all have to hit. And funny enough, regardless of which countries you actually are from, they usually are fairly similar. So the 3 criteria are income, credit, and down payment. So in certain countries, your income level might be a little different, or rather, the debt servicing ratios could be a little bit different depending on where you live. And credit score systems might be a little different, and credit score requirements might be different. However, it all really boils down to your credit history, your behavior when it comes to dealing with funds that you've borrowed, how you pay it back, how long you've had it for, how many different kinds of debts have you serviced over the years, because it's all lenders' ways of assessing you whether or not you're actually a trustworthy person to lend money to you. And last but not least, it's down payment. So once again, in Canada and actually in the US, we're fairly lucky in the sense that in order for us to get access to mortgages to buy income properties with, we usually oftentimes only need a minimum of 20% down. And I know for some of my friends, if you're from Singapore, because I know I have a lot of international viewers as well, if you're from Singapore, you do know that you oftentimes are asked to come up with 50% down payment or deposit before you can even get into a secondary property, meaning one in addition to the one that you currently live in already. And so we're fairly lucky in that sense. However, the point is, I'm squeezing as much in here as we possibly can, because this is how you are able to start to learn how to scale. Because when you're going out there to speak to people why you actually want to invest in real estate or choose real estate as your main vehicle, you can now speak to it intelligently rather than, hey, you know what, real estate usually tends to go up. Does it? Well, you know what? Maybe, yes. However, it still depends on the market, and there's so many different factors that go into it. However, I just want to be able to give you guys the different bits and pieces, and you don't have to learn how to speak to the whole thing like what we're covering this entire week. However, it is good for you to take away some nuggets here and there as well. So today, we're going to focus on the tax benefits. And as you guys probably already remember, I am not a lawyer, I'm not an accountant, and so as a result, I'm purely speaking from a business person's perspective, from an entrepreneur's perspective, from an investor's perspective, not from an accountant's perspective. And this is why there's a little bit of a star right next to it. Okay, make sure you still double check with the accountants in your jurisdiction, in your province, in your state, in your city, in your country, to make sure how it functions. However, there is still a general umbrella understanding in comparison to all the other investment vehicles that are popular to the general public. And so that is the direction that we're going to go into today. Okay, so from a tax benefit perspective, I want you guys first of all to remember this. Okay, we always talked about the fact that it doesn't matter who you are, what you do, you make your money, you spend your money, and at the end of the day, even on a personal level, we hope that you actually stay in the positive zone. And this is why we keep saying that with every single property that we purchase, we always make sure that there is a positive cash flow, because that is what makes it a sustainable business. I want you to think about it this way, because funny enough, so many people, they just think that because it's real estate, it's supposed to go up in value. Yes, you know what? Chances are if you hang on to something for 10, 20, 30 years, it should probably go up in value. Okay, even if the general real estate market is not exactly going up, there's still inflation built in, and usually that'll lift the market regardless. However, that's the whole idea, is that we don't bank on it. Equity growth is kind of like a piggy bank that we keep putting money into that we're not allowed to open. So equity is like a piggy bank you cannot open. And this is why, again, we treat this as a business, and therefore we treat every property as a business, as a viable business. And when we do that, it doesn't matter how many properties we add into our portfolio, it should be a cash flowing or positively cash flowing business. And that is actually what pays the bills. And that's what we focus on. However, the whole point here is this part is what gets you taxed. Okay, so what that really means is that ultimately speaking, your revenue will go up. Your revenue could come from rent, it could come from your parking, it could come from storage. We cover some of this in season 1 as well. There's a few ways that you can generate a revenue when you hang on to an income property, and it still depends on the type of income properties that you're hanging on to. Okay, and then you have your expenses. For a lot of people, this is vacancy, this is repair and maintenance, this is property management, this is other things as well. The whole point though is, just like an active business, you're only taxed when there is a leftover. So that's great, okay? And we're not even talking about value going up yet, because if you're investing your money in stocks, in mutual funds, in anything else, when you sell it, no different than real estate, usually you get the capital gain tax. However, this is why, again, we buy and sell to create capital so that we can buy and hold to create long-term wealth. And so when we have the vision to hold on to properties, we don't actually buy and sell that frequently. Okay, so where I'm going with that really is the fact that, let's just say, if you have, let's say you bought a stock, you bought into a company stock, and then you originally put in 100,000, and now, let's say, after 10 years time, company's doing really well. And if you invested in Google, Apple, Amazon, or Tesla, it probably is worth way more than that, okay? However, we're just gonna do it that way. Today's value, today's fair market value right now, this is your book value in terms of how much you've actually put in. Now, if we put a property here, okay? So yesterday we already spoke about the fact that if you put in the same $100,000, you can actually buy up to 5 properties. And so let's just keep that in mind, okay? And so say if this is the same growth, this is basically double, we already know that this actually turned into a $500,000 portfolio. However, there's debt in there, Okay, there's debt in there, but let's just say today's fair market value times 2 is $1 million. Okay, so if $1 million is today's value, and the book value originally when you purchased it was 500,000, over this period of time, usually you also have not just cash flow but equity paid down as well. And this is where we would typically ask you and advise you, unless you need to access the entire capital amount. Okay, this is typically where we would suggest that you actually do a refinance and pull out the equity. So let's assume that you're able to pull out 80% against your entire $1 million portfolio. That means you get to pull out $800,000 in cash. And assuming, because remember this, we actually owe 400,000 here. Okay, so even if we pull out 800,000, however, let's just say that this is 10 years later, and you actually still owe 300,000. That means you pull out $500,000 when you refinance it. So what that really means is when you pull out that $500,000, depending on your corporate structure, that's something that we will go into as well later on. That's more of a high level, more detailed understanding when it comes to asset protection and the concept of tax benefits and tax sheltering altogether. Now, this coming back here means that you get to pull out effectively $500,000 tax-free. Why? Because you did not sell that asset. So as a result, you're actually not triggering the capital gain taxation, number one. Number two, when you pull out the money, that money is a loan, which means it's borrowed money. You don't get taxed on borrowed money. And that's how we can actually grow and leverage constantly with real estate as well. And so for those of you who might be kind of getting a little bit lost, I would highly suggest that you go back to season 1 and find 2 episodes in particular. The first one is deal analysis on an income property, okay? And the other one is the entire BRRRR process, which is buy, renovate, rent it out, refinance, and then repeat. So you'll have a better understanding in terms of what we're talking about here. So let's come back here. If you do decide to pull the money out, most of the times when you are pulling money out from your mutual funds or stock portfolios, that actually means that you have to sell the asset. In this case, it's your stocks. So when you do that, it actually triggers, okay? It actually triggers capital gain tax right away. Now, depending on how you bought it, I'm just going to use a very broad stroke at the moment. If you actually bought it, let's say in Canada, under your personal name, depending on your income bracket, some of you might be actually taxed up to 50%. So think about that. Let's say if you cash it all out, on paper, it looks like you can actually make $100,000 net. However, after tax, you might only be able to take home about $50,000. How happy are you when that needs to happen? Okay, so again, there's no right or wrong, and we also definitely focus a lot on diversifications into different asset classes as well as investors, as smart business people in the long term. However, in the short term, this is also why we want to show you why invest in real estate. There's so many different ways to not just maintain control of your assets performance, you can leverage like nobody's business. And again, it's never about how much you make, it's really about how much you get to keep. And so that is my short talk today about the tax benefits in why investing in real estate, or why leverage real estate as your investing vehicle. So thank you so much for joining me again. If you find this helpful, please like and comment, and make sure that you share my Daily Dose with Tim with those who you think needs to start learning, needs to start to understand how this particular investment vehicle can work to your advantage. And honestly though, I might be really biased. However, I really do believe that real estate is something that everybody needs to learn about and get themselves into, regardless of what your financial goals are. So I'll leave leave it at that for now. Thank you so much once again. Have a great evening, and I will see you back here tomorrow. Bye, everybody. Live well.